Hi, I'm Vineet Agrawal.
Hi, I'm Saurav Ghosh. We are the two co-founders of Giraffe.
Jiraaf is India's one-stop alternate investment platform.
The difference between the rich and the ultra rich is simply this: the ultra rich don't work for their money works for them. This essentially means that ultra rich are much smarter about investing their money and using the power of compounding to grow their wealth. But thanks to startups like Giraffe, just about anyone can get access to the kind of investment deals that were previously only available to the ultra wealthy. Giraffe allows its users to directly invest in corporate debt instruments and eliminate the middleman, which is the bank. This can allow your money to earn double as compared to what you earn when the bank takes your money and lends it to corporates. Stay tuned for the conversation between your host Akshay Dutt and Saurav Ghosh and Vineet Agrawal, the founders of Giraffe. And remember to subscribe to the Founder Thesis podcast on any audio streaming platform to learn from some of the smartest fintech founders in the country.
So I was born in Calcutta, but grown up in Mumbai. Growing up, I always had some inclination towards corporate setup. I stood first in my school, went to good 11th, 12th junior college in Mumbai, Ruparel, then joined BITS Pilani. I went for my engineering to BITS Pilani, the Goa campus. Post engineering, I went to do my MBA at IIM Ahmedabad. And over the last decade now, prior to starting with Giraffe, I was essentially in the corporate environment working for different companies. I started my career in the infrastructure sector with a company called Feedback Infra in the North. And then I moved on to a few real estate companies in Bombay and Bangalore. So when I passed out, I was essentially through campus placement, I got into Feedback Infra, which was into the infrastructure space. They also had a real estate division. And towards the end of my stint there, I was essentially consulting real estate companies at that point in time. And one of the last stints I had was with Vadva Group, and they offered me a job then, and then I actually moved into core real estate in that sense, right? So Vadva Group is one of the top 5 developers in Mumbai, and started my career there. That's my foray into real estate. But while being in real estate, I was always in finance. So my core job in all these companies was always fundraising and being very capital intensive sectors, I think money has a big role to play in real estate industry, and I got a lot of exposure in financial, I would say, capital raising, where I've raised capital now from international private equities, domestic funds, private sector banks, public sector banks, and the likes, right? Vineet and I met through our professional careers. So because I used to raise money for the company that I worked for, and Vineet used to be an investor or a lender, and we did approximately more than 15 transactions, maybe totaling to 2,000 crores over the last 10 years.
So, Vineet, how did you end up in the world of finance?
So, see, it was just post MBA. So, I did my engineering in mechanical engineering. Okay. And the world of business is something which always excited me, even when I was doing my engineering. So, post engineering, I had two choices whether to do, an MTech in either automobile or aerospace engineering, which a lot of my batchmates did, or you could go into the world of finance via doing an MBA. For me, the choice was clear because this is something, maybe being a Marwadi money is something which always naturally comes to you. And even post the MBA, I was very clear that I wanted to do some sort of a job which is very closer to understanding different types of businesses. So the natural choice while applying for job was that there were certain opportunities in banks where you could work in the credit space, and the job was that you will analyze different types of businesses and you will basically actually eventually lend them. So initial part of my career, which was around 3 years, I spent in the corporate banking space. I was part of mid corporate team and then large corporate team in State Bank of India, followed by Axis Bank. And then in 2013, I moved to a smaller setup, Piramal Fund. They had just started then. It was private equity slash NBFC kind of a setup that they had started. That was an opportunity to actually build something of our own from scratch because I was like the 10th employee to join them in 2013. And we grew that company from almost like a $50 million AUM to almost $8 billion AUM over 7, 8 years. I was like one of the first employees to be hired by them in the entire South India. So we built the entire team in 6 years. We changed offices like 5 times. We grew from a 2 member team in South India to almost a 70, 80 member team. Okay. So it was almost like a well funded startup where a lot of authority and empowerment was given to us at a young age to build the business.
And that's how, like, you were lending to Saurav's employer, which was a real estate business. So that's how the relationship got started. So yeah, tell me about the birth of Giraffe.
So just to give you some context, Vineet and I, we actually both quit our, say, corporate jobs just post COVID. We were still like largely corporate professionals, right? We still didn't have the risk taking appetite in some sense, if I can put it in that way, to directly, start and go to a full fledged startup. So I think the easiest step that we took was, basically quit and start a services company. Service is a very different business because you're a few people who are running a small setup. You get monthly cash flows. You can still draw some salary. You're actually working with quite a few of the large developers in the country, and that was I would say, a steady business. Giving steady cash flows, and we were doing quite well. In fact, I think in 1 year, what we built with Uniturn was commendable and great. Even when we think about it today. But what that helped us to do in that 12 months is that once you start doing something of your own, it suddenly gives you a lot of freedom and flexibility to experiment. So we are trying to figure out how do we build our expertise, in the financial services side while we are a part of this services or consulting setup. And that's when actually it so happened that, Vineet had written I would say, a LinkedIn mail to one of the founders of this startup called Eel Street, which is there in the US. It's actually very similar to how Giraffe is set up today. It's just that, obviously they are 3-4 years older and they are focused in a lot more exotic assets because the mainstream debt instruments in the US are very easily available, right? So, but we had that conversation. So when we looked at Eel Street, we were like, hey, we have the expertise to do, this exactly this in India as well. And, I think we are quite well equipped to do this because we have that expertise. So Siddharth Shah, who's the founder of Farmeasy, he's a batchmate of mine and a close friend from IMA. So he was in Bangalore. Vineet and I met him for dinner. We bounced this idea off with him. He, was really interested. He said, hey, this is fantastic. I think there's a big market out there to build something like this in India. Both Vineet and I are not tech founders, right? We don't have that tech background. So, building a tech platform is something that we felt was challenging for us. But speaking to a lot of people, post our conversation with Siddharth, gave us a lot of clarity and idea on how do we go about doing that. And then that point, we kind of, four of us met, we kind of took a decision that, Srivin, Naveen, who are elder than us and who are with a more traditional mindset are well, geared to running a services business because that's where their expertise. And Vineet and I, being younger and having that, I would say, a more experimental mindset, should take the plunge with Giraffe.
So you like let go of your equity, or like did you give them equity in Giraffe, or how did you structure the exit?
Our thought was quite simple. So Vineet and I had obviously, like I would say, played a role in the early days of Uniturn, at least in the first 1.5 years, to build that as a business, right? But we kind of said that since now we are moving out, we renegotiated and reduced our holding in Uniturn and then moved on to Giraffe. And obviously, Srini and Naveen, they come with, 25, 30 years of experience themselves. They can support a lot in the initial days of Giraffe and building Giraffe as a platform. And so they were on the board as advisors and mentors, and they had a certain sweat for playing that role and adding that value to Giraffe. Right. So that's the way the thing got structured.
So what was the opportunity you spotted which you thought that could be built into a large business?
Yeah. So as Saurav mentioned, so we, it was like a small office with four of us sitting and just debating ideas half of the time. In my previous job as well, we did a lot of structured transactions. So there was specifically one transaction, which was the embassy REIT transaction, which we keep on referring to. Okay, that was the first REIT in India, and it was, pre-funded by us, and it was like a 16% IRR deal backed by REIT securities. And we wanted, as an employee, we wanted to participate in that transaction, but the minimum ticket size for participating in the transaction was around 3 crore. We thought, if people are given opportunity to invest in good quality transactions, there will be a market for it. The only places where people tend to invest is equity, real estate, or gold. Apart from these three asset classes, there is nowhere else where common folk can invest. And if there is a platform where we can provide those sort of opportunities, there will be people who would want to invest a portion of their wealth.
Just to break down the REIT deal, which was the birth of this idea. REIT is like a real estate investment trust in which a company takes money from public, like a mutual fund, I believe, and then they buy real estate with that, and therefore the public has that fractional ownership like you would have in a mutual fund. Is that the concept?
It's approximately what you're saying, but not exactly the same thing. And the only difference is that you already have an asset, somebody already owns that asset. You basically lease it that out, and then you move that asset into an SPV, and then people then become a unit holder in that sense.
Okay, so it's like an IPO for a real estate asset, basically.
publicly traded.
Oh, yeah, right. You make that real estate, you fractionalize it into bits of ownership, and those become publicly tradable. Okay. And so, what was this opportunity which gave you a 16% IRR? Like how is the REIT traded? Is it on the basis of the value of the underlying asset? Is there like a fixed formula for the price of the shares of the REIT, or how does that happen?
Yeah, so it's the pricing is like any other equity, right? I mean, it's a supply demand kind of thing. At the underlying, you have an asset and you have an yield. But if people believe, the yields will rise in future, then obviously the price of that particular REIT keeps on increasing. So it's linked to the market that way, the pricing of the REIT.
So essentially, what you're saying is there are corporate debt deals which earn as much as 16% and maybe even 20% rate of interest, which is really beats equity also. I think long-term equities give less than 20%. But a normal person cannot access it because of the minimum ticket size, and you need to be like an NBFC or a certain type of an entity to really get access to those kind of deals. So there is an opportunity there to make that kind of a deal available to, let's say, someone who's like just about an HNI.
Yeah, not only the ticket size. Actually, one reason is the ticket size. Second reason that is knowledge. So there are not many people who are aware that there is something like this. You might have money, but you're still not aware. And the third would be the accessibility, right? So those three things is what we are trying to basically solve.
So there is no one out there who's actually structuring proper debt opportunities, keeping retail investors in mind, and opening it up for their patient. And if you look at corporates also, for them today the only source of capital is institutions. So even corporates don't have access to retail as a source of capital. So just joining all these dots, so there is, where we thought the big opportunity is. And like I mentioned, it was a intersection of our expertise of a large opportunity and creating some value and impact.
Okay, so I did a BCom degree about 20 years back in which we learned about something known as a debenture, which is essentially something that public can participate in corporate debt, right? So what is the need to create Giraffe? Why doesn't that debenture concept work?
Right. So debenture is an instrument. It's like an equity, like it's like a share. Right now, this debenture, similar to any equity share, it can be listed or unlisted. Right. And like you have today privately held companies. Similarly, you have privately held debentures. You also have publicly held debentures. Right. So now I'm just drawing analogy from the equity market to debentures and the debt market. Right. So all today you will see a lot of these large scale public corporate bond issues. Right. Like like all of these, Reliance, they keep raising through public debt markets. All large AAA rated companies today are raising capital from public debt market because it's cheaper source of capital. In India, the way it is that only your top tier corporates have access to retail as a source of capital, which is done through these public debt issues. Now, the reason why the next tier of companies don't have access to is because of three reasons. A, in India today, debt products are only looked at only from the lens of rating agencies. You know that this is a AAA rated debt paper or a AA rated debt paper or a A rated debt paper, and that is giving you some sense of the underlying risk of this opportunity. Now, and the biggest challenge in India is the lack of faith in rating agencies. Suddenly, today a AAA rated ILFS, a AAA rated DHFL, a AAA rated Yes Bank, suddenly if they default the next day, how do you build faith and confidence on companies which are AA, A, triple B plus, etc. Right? So there's a genuine lack of faith or trust in rating agencies in India. And today you participate in Reliance and Tata because you identify with the brand, you identify with the institution. But if a lesser known company,
The trust is there.
the underlying trust is there because of the strong brand value. But if there is a company which is great business, running profitably, great in its operations, but doesn't have a brand because maybe it's a B2B company. So, it's not a consumer brand in itself. But how do you then build trust with a company like that? Right? So that's the core of it. And because of this, I would say big lacuna, the debt markets have not developed. I would say the consequent effect of that is even the debt market that exists, then the liquidity is very low. The liquidity is low, so you're not able to exit your debt, I would say investments easily, right? So these are all the effects of it. Third, I think the government itself has not done enough to develop debt markets, right? And the biggest challenge in debt markets is taxation. Like while we offer, what we offer, and there is equity and debt can give you same returns, but once you give equity such favorable taxation, post-tax returns kind of change, right? So I think the government needs to step in and do a lot to also help debt markets mature. and opening up for wider participation and also, from tax and other regulatory aspects. And then what happens is these small debt issues are all privately structured and HNIs participate because they understand risk. They are able to take those calls. They will have these wealth managers like IFL, Edelweiss, Avendus. They will structure these privately closed transaction, where 15, 20 HNIs participate for 100 crores. And that's a transaction that is specifically being catered to them. So this market is now then being privately built or very built in a very closed manner. And so, what we are trying to do with Giraffe is just open up this entire ecosystem and say that, we will structure good quality opportunities for you. We will bridge that trust deficit you have with rating agencies so you can build trust on a platform like Giraffe and our credit process. And then we are opening up and giving equal access to such good quality opportunities to everyone. Doesn't matter that's an HNI, mass affluent, or an average retail investor. The opportunity for wealth creation should be unbiased and equal for all.
So why couldn't then Edelweiss just open it up as well to HNIs? It would not be too big a stretch for them to just build an online platform where not just the UHNIs but even HNIs and slightly below HNIs also can just come in with, let's say, a 1 crore minimum ticket, a 1 lakh minimum ticket size.
Yeah, they can do it, but see, you need to have a mindset of being a tech company. So that's the difference. See, I would say the existence of, I would say at least 90% existence of fintech in India is because of the inefficiency of maybe the existing banking solutions. So, like for example, Neobank, can a SDFC not open a bank account using tech? Yes, it can. But see, it's not the DNA of the company, right?
And how does an Edelweiss earn when they do a debt deal? Like, let's give an example that 20 HNIs come together, fund 100 crore deal, a debt deal. What is Edelweiss earning in this?
So they do it in two ways. One is for like Edelweiss, because again they have multiple vehicles at their disposal, right? They are also an NBFC. They have funds of themselves, similar, IFL as well. So they sometimes they take these exposures on their books and then downsell it, and they earn a spread. Like they'll do a 20% transaction and actually downsell at 18%, so making a 2% spread. Sometimes they earn a distribution fee from the company if it's not taken through their balance sheet. So there are multiple ways for them to earn fees. Also one more, like just adding to what Vineet said, like the reason why Edelweiss or IFL they don't do this or can't do this, see, the traditional wealth, right, has been a very in-person advisory and service model, high touch business. So for them, they are like, I need to give the same service to a guy who's with 50 crore corpus, 5 crore corpus, or 50 lakh corpus. So traditionally, then they are serving, obviously, from them, the ROEs or return on effort for them is a lot more if they service the ultra HNIs, HNIs. Now, the only way to make a profitable business by servicing like retail investors is by being tech first. And because of them being such large profitable, they can't be a tech first organization today. For them, tech will always come later. They can invest in tech, but it will always be secondary for them, right? So we kind of, change that and turn that around and say we are a tech first company. Now the focus is in creating, non-linearity through tech, right? So that's essentially just what Vineet said.
Okay, got it. Okay. So now I'm guessing here's what you would have needed to do. Like you would have probably first needed to source a good deal, right? Even before you go out to source investment money. Because the way to source investment money is by having a good deal, advertising a certain return to make it appealing and attractive. So, tell me that journey.
So see, the first deal was very easy for us because see, as we said, because both of us come from a real estate background and we understand real estate investment really well. So the first deal that we did was was a real estate transaction. It was with a counterparty, which is Saurav's ex company, which is Vadva Group. So it was like one of the top developers in the country. We wanted to obviously bring the first opportunity, which is really exciting. So it was very good IRR, short tenor with a very good brand name, and for a sector which we understand really well. So these were the criterias for us. And that was the first deal that we did. It was a 20 crore transaction. It was actually a 120 crore transaction, the entire transaction. And because we were just starting then, we were not confident as to, how many subscribers will subscribe to this paper. And what we did was that, we spoke to like JM Financial to subscribe to a large portion of the entire debt. So around 100 crore of this 120 crore was taken up by JM Financial. And we subscribed to 20 crore. And this 20 crore was then listed onto our platform. And then obviously, it took us some time to sell the entire time.
And what was the rate of return?
16%, 16.5.
Okay. So what is the process for her to get onboarded? Is there a certain Can anybody buy this paper? And by buy this paper, it means essentially give this money to Giraffe to further lend it out. So can anybody do that, or is there a criteria? What is the way in which you onboard investors?
Yeah, so basically anybody can come and invest in Giraffe platform. The only threshold is that we have a minimum ticket size of 1 lakh rupees. So that is the only criteria we have. Apart from that, we don't have any restriction as to who can come. Obviously, we do follow the prescribed KYC guidelines as prescribed by RBI and all. So that process has to be done. Right.
Okay. So just the basic KYC, which is like
Right.
Aadhaar and PAN, right? So that you need to do, and then 1 lakh. Anybody who's ready to invest 1 lakh or more can access this investment opportunity where they get a 16% rate of return. What was the duration for this first one? And
That was a 2-year transaction, but it got prepaid in less than a year, in fact.
so tell me how you sold this. How did you find investors who would want to invest in this?
Initial investors were obviously friends, family, friends of friends. That, when you start platform like Giraffe, obviously nobody knows about what Giraffe is, right? So you try and reach out to whomever you know, and then you try and explain them about the transaction. We were lucky enough that, especially in the financial world, there are a lot of people who know us and, are aware of what the transaction is. So a good portion of the said transaction was subscribed by, people from JM Financial itself and from, Wadhwa Group itself and, our friends and families. So that was the first deal.
Like we said that no one knows Giraffe, right? And investment is a very trust-based process, right? So while there is no trust on Giraffe because it's actually not even existing before that, so where do you derive trust from, right? So the trust then comes from people who know Vineet and me, and the trust comes from people who know Vadva Group as a counterparty, right? Because then they appreciate that there's a good quality developer, there's a good quality underlying and a product, etc. Right? So that was and then that's the kind of strategy that followed what Vineet said, right? Like we reach out to our friends, network, people who understand real estate well, people who understand finance well, explain the product. We reached out to Adva Group and their employees because you're like, hey, you know your company the best, you know how good that is. Why don't you try and participate through us? We reached out to JN Financial because their employees, because they were anyway co-lending in the deal as well. Right. So we're like, your organization has done a credit. Why don't you come and participate? Right. So it was a mixture of like, how do we derive that trust from? Which are those aspects and I would say opportunities, for people to build confidence on the product. And that's the thing that we followed.
And was the tech ready before the first product? How did you do the plumbing of getting the money from retail investors to Vadva Group?
Yeah, so tech was ready. So the tech journey, it's also an interesting one. We got introduced to this firm called MVP Rockets, and they were also starting up in actually providing services to startup to build their MVP. They were a great team. Praveen and Giri are their founders. So they were a great team who helped us get off the ground and build the product. And in fact, we started engaging with them in July. And 1st September, the product was ready. 10 September 21, which was Ganesh Chaturthi that year, we launched Giraffe. And 20th September, we launched our first deal, which was with Vadva Group. So in fact, the transaction was done online. Our very basic tech was ready. It was very basic then, but you could come, view the opportunity, invest your money through a payment gateway and net banking, and we would allocate the securities. So that was a very basic infrastructure which was ready, when we launched that deal. Yeah.
And how did you structure it? Like the money would go to an escrow account and then it would go to Vadva Group. Was it directly going to Vadva Group and Vadva Group was paying you a sourcing fees or like?
No, so again, we took JM Financial help over here. So because we had structured the opportunity, we had told them you need to warehouse this transaction for us for 2 months, right? So in fact, JM Financial held this. So they had given the entire money, 120 crores to Vadva upfront, and then they held these debentures on their books for us. And as and when we used to find investors to sell it to, they used to transfer the debentures to them. So it was, so that was so from Vadva's perspective, they got a single shot check from JM Financial, and JM Financial that time was kind enough to, warehouse it for us and help us get started, in our early days. Yeah.
And what is the price of one debenture?
So that time it was 4 lakh rupees. Yeah. So the first product we did was a minimum of 4 lakhs.
Okay. This today you brought this down to 1 lakh. Okay. So essentially, the way it would work is you would find a party which needs debt, and you would structure with them debentures which are worth 1 lakh each, and then you would find people who will buy those debentures. And how would you earn in this?
So because we structure the entire opportunity, right? So again, we are able to take a processing fee, a platform fee, which is a typical, I would say investing parlance. So we take a one-time fee from these companies for structuring the transaction and providing them capital. And so if you look at it now from a company's lens, when we structure transaction, a company agrees to a cost of capital that the company is willing to pay. And we feel that this is the IRR or yield at which I should list it on the platform so that it's a fair pricing for retail investors. And then there is a differential, the cost of capital that the company is paying, the yield or IRR which the investors are earning, and that differential in between is what we make as a one-time fee. Right? So effectively, that's the way it works.
Okay, which you directly charge from the company. So like the company will say, okay, I'm willing to pay 18% for access to debt, and you think that 16% will be a good pricing for it, and that 2% you will charge the company as a platform fees, and you are earning from the company only. You don't charge the investors. Okay, got it, got it. Okay. So doesn't this have an inherent conflict of interest that you are not representing the investors, you're representing the borrowers?
Because we are charging fee from the borrowers. I think what is important to understand is, we are trying to be in a business, build something which will last decades. And Giraffe believes in this credit quality, and that's why we are offering it to you. Right? We can charge, investors as well. It's just that, it's easier to deal with one counterparty than with 100 investors.
So essentially, if you were to charge investors, then your cost of sales would go up quite a bit because it would there's a little more friction to make an investor understand why you're charging him, etc.
Right. Then it becomes that, we'll list something at 18%. I will charge 2% fee. So I have to tell the investor you're getting net 16%. And a lot of question around, can you give me a discount of 1%? I don't think 15%. So we are like, we want to give you one fee which is clear, no terms and conditions attached to it. You get what you see. We also price it based on what we feel is fair risk, right? Like in point is that investors should get a fairly priced product. So they are taking some risk. They should get a fair yield commensurate to the risk that they are taking. Now, how do I tell an investor why I'm charging 0.5% spread in one transaction versus a 1% spread in another transaction? It's very difficult to explain to people who don't understand the structuring aspect of it as well. So we want to make it simple for retail.
So you have started buying on your own balance sheet now, like what JM did for you earlier, where they bought those debentures and then they kept transferring to your investors. Today, you do that on your own balance sheet.
Except that one transaction, I think everything we have done on our.
Okay. So after this one deal, what next? Did you then try to raise seed capital? Because if you did subsequent deals on balance sheet, then you must have needed seed funding.
Actually, seed is what we had done when we started of that $1 million. Okay. And after that, we did our, larger round of around $6.5 million, which was led by Excel Partners. Yeah. So we raised capital, which is helping us to do the transactions that we are doing today.
Okay. Okay. And tell me the journey. So you did that one deal in 2 months, subsequent to that next couple of months, what was the journey like? How many deals were you doing each month? How much time was it taking you? How much amount were the deals worth? How much were you like just take me through that journey to where you are today?
So initial 4-5 months was quite challenging, I would say, right? So we launched this first deal in September, right? We thought that we will be able to distribute it maybe faster than what we eventually ended up doing, right? So it took us 75 days. Then the second thing that we were very clear about that we wanted to set up Giraffe as a multi-sector or sector agnostic and product agnostic fixed income platform. So we didn't also want to keep bringing real estate opportunities because while we knew we could, build a very large exposure there, but the idea was to, ensure that we are able to set the stage for Giraffe to be a multi-product horizontal fixed income platform. So the next one, and we also wanted to obviously also demonstrate that, we are able to structure products, bring opportunities, in varied asset classes as well. Right. So the second transaction we did was then completely different. And the focus, kind of shifted. So we said we'll not do corporate debt. We did a product called leasing. This was with, Everest Fleet, which is Uber's largest fleet operator in India today. So today they have 6,000 cars on the Uber platform. But back then when we spoke to them, which was in October 21, they had, almost 1,000, 1,200 cars, back then. So they are not as large as what they are today as well. But we went and met their founder, Siddharth Latsaria, got a lot of comfort on the business that they're doing. And then we were able to structure a very small 5 crore opportunity because it was, we had seen the challenge we faced with our first opportunity in distribution. So we wanted the second one. We realized let's take smaller. So we took a 20 crore transaction as the first one. But we said we should now choose smaller, ticket sizes subsequently till we build our own strength, right? So we did a 5 crore transaction in first week of December, which was our next opportunity post end of September, right? So almost after a 2 month kind of a break. And then so this also took us about 60 days to kind of distribute. Almost it went till end of Jan, first week of Feb 2020.
So this was essentially like money to lease cars. So it was like an asset-backed loan because the car is there as a collateral.
So, and this cars is we really like cars as a asset, right? Like today you can lease computers, you can lease, variety of things, but cars, especially in the Everest concept was very good because it was an operating revenue generating asset, right? Because the car was being run on a Uber platform, every car generated revenue and it generated more than enough of revenue for, the lease that they were paying us as a fraction of that, right? So and the secondary market for a asset like car is well established, the pricing is well established, so just from a leasing construct it just ticked all our boxes. We really like Everest as a counterparty. I think they are one of the most efficient car operators that Uber or Ola has probably today in the country. So all boxes ticked, and again I think we were able to structure a really good
And
trade.
so Everest has drivers on their payroll, is it? Like they buy cars and then they employ drivers and then this is deployed in Uber's network.
Yeah, they are not exactly on their payroll. They're like contractors in some sense, right? Like, so not on their payroll, but yes, like, they are the drivers on their salaries, through Everest. So I think what Everest adds value to drivers is, and obviously the car ownership, is then taken care of. So driver doesn't need to, so, that's a big hurdle or roadblock for, most people who want to start driving, right? So the capital problem is solved. And then Everest also takes care a lot of their ecosystem, right? Like for insurance to just health benefits to a place of stay. So the entire ecosystem is then very eased out for the drivers, and obviously the drivers get money committed at the month end, and they see because of Everest and the way they run the car efficiently, also the utilization of the car is higher than what probably the drivers would have done themselves, because they are deploying cars based on data. So they exactly know how many cars to deploy in which city, where there is a demand, etc. Right? So from a driver perspective, like then tying up with Everest is quite meaningful. So that was our product 2. And then product 3, we wanted to then again further say that we will go to a new industry with a new product. So we did corporate debt in the real estate sector. We did leasing with Everest. The third opportunity, we said we will wanted to do an invoice discounting transaction, so where we are funding working capital and receivables. So for this, essentially, then what we did was the challenge with invoice discount and receivables, it's a 60, 90-day product. And while you don't have demand predictability, if I take 60 days to distribute a 60-day product, then that's challenging, right? So we had, work reverse in this case. So what we started doing was we had a company called Aris, which was also a startup, but they had raised significant amount of equity. We had common shareholders, so we got introduced to them. And we knew there is a need for working capital over here in this company. And then we started pitching it to, again, HNIs to begin with, to say that, hey, are you interested in participating? If yes, I have this opportunity. So whenever we got a commitment from these HNIs or large investors, we used to then structure and back-to-back do the transaction, so that we don't spend time in distributing that product on the platform. Because like you said, otherwise we had no clarity or visibility on, if we just listed how much time we will take to kind of distribute. So we started building scale then by servicing these initially, 7, 10 HNIs, doing these inward discounting transactions, with parallelly distributing Everest, which took us 2 months. And then in Feb, we did a fourth product, which was again a corporate debt, but we now did it with an NBFC, right? So by Feb, the other thing was, Akshay, we had set up a decent team. So, when we had done our first opportunity, we were a 5-member organization. When we did our second opportunity, Everest, it would be a 12, 13-member organization. By February of 2022, this year, we were a 18, 20, kind of a member organization. So, right. So then we had a head of investments, Vikas, who joined in. He came with a great pedigree, prior to starting off with Jiraaf. Who was a batchmate of mine, came with a great pedigree, in the venture ecosystem. So the team and the leadership team also started falling in place. And, we were then able to, I would say, spread our wings and actually, deliver on all the expectation that we had of ourselves, right? So we said we wanted to create a multi-product platform. So by February, we wanted to create a sector agnostic platform. So by February, we had done a corporate debt in real estate. In February, we did our first corporate debt with an NBFC called Home Credit. We had done a leasing transaction already. We had launched our first invoicing with noise discounting product already. So by Feb, if you see, our first 4 products, they were all different, each with completely different size and scale of counterparties. And you started delivering on what we, essentially set out to, which was create a horizontal platform. And after that, it was just, trying to then build and scale each of these verticals independently, right? Can I do so much of corporate debt in real estate? Can I do so much of structured corporate debt? Can I build the leasing book? Can I launch venture debt as a product? And can I also can I scale invoice discounting in parallel? So then, it was kind of, things started falling to place and we started then focusing on. So I would say we had done 0 to 0.5 of the journey, which is just the initial team, launch the platform, launch one product in each of these categories, and then to say that can we really create a business out of it, right? Can there be traction in each of these products? Can we do it seamlessly? Can we start doing this month in, month out? Those are the aspects then we started focusing on.
So, like for the unit for corporate debt is a debenture, which maybe 1 lakh is what you would price it at today. For leasing, is the unit one car that an investor comes in to lease one vehicle?
No. So you can invest like 1 lakh in that also. So in that also, there are two structures. It can be debentures. In that, again, you can have 1 lakh, or if you are forming an LLP or a private limited company, the value, the partnership interest is basis the amount that you invest then. Need not be the minimum investment of a car from an investor's perspective.
Okay. Got it. So it's not like if I'm giving 1 lakh, it's not like there's one car mapped against me. It's like the overall debt is broken down into lots of 1 lakh. Okay. And the same would be there for invoice discounting also. It's not be like there's a particular invoice which is mapped against me, but it's like an overall thing.
Yeah, no, particular invoice is mapped, but in one invoice, you might have 100 investors. So that's the.
And if it's not a round figure invoice, like let's say if it is something and 16,000 rupees, like say 5 lakh 16,000.
Yeah, so there will be someone, like sometimes we have that last 1%, which is like a odd number. So even if it's less than 1 lakh, we allow someone to participate. So
And most of the time, what we try is that, you have a margin concept. So suppose if the invoice value is 105 rupees, we actually fund 100 rupees only. So 5 rupees is like the margin. So that all.
Got it. And so what is the traction now today? Like how many people have so far invested through Giraffe, and what is the monthly amount that is getting dispersed and so on?
currently have almost today 40,000 registered, investors with us. Almost, 4,000 of them are unique transacting investors on the platform, right? And we see very healthy engagement metrics with, with all our investors today. So almost 95% of people who have participated on the platform are active, with us, and they continuously, transact. A lot of every month of our like 4,000 user base every month almost, and this itself is growing, right? So every month 50% of our user base transact, so that means, let's say we have 4,000 investors today. In this month we will have 2,000 unique investors participating, and that's the same next month and the month after, right? And this is a trend now that we have seen over almost a year, right? So so the engagement level with the users are very high. Almost every investor invests 3 to 4 times, from the month they join to month 3, month 4 itself, right? And we knew that we are not going to a very mass retail segment. So, by keeping a threshold which is 1 lakh rupees, it's a significant amount for a unknown platform for someone to transact digitally. Right, it's a significant amount of money, So we, in spite of that, we see healthy engagement metrics. People are transacting. They have an exposure of almost 6 to 8, 10 lakhs, with Giraffe as a platform, on an average. And because of which today almost now, we've done about 650 crore of disbursements in our, I would say first 12 months of our journey. Today we are at a run rate where we are doing more than 100 crores month on month. Right. So, and, we work with almost now 30 unique companies, that we have built relationships with in the past 12 months. We also returned significant amount of capitals out of almost 100 plus. In fact, a few days back, we crossed 100 fully repaid opportunities as well. Right. So, where we've paid out capital like in form of interest and principal, almost 300 crores back to, our investors as well. right? So I think a lot of the, I would say a lot of engines are firing, a lot of things are, falling in place. We are trying to ensure that all growth that we achieve is also sustainable, right? So we are able to deliver these numbers now on a month-on-month basis also, and kind of see that, how we take that next leap of growth. So that's, always a focus area for us.
So, your initial set of investors were through your personal network, but you must have formed like a more like a go-to-market strategy to acquire customers. I would love to hear about that.
Yeah. So see, there are basically two channels that we generally employ to get our customers. One is our digital or direct channel that we use to get our customers. Another is that we work very closely with the financial advisor ecosystem, and we do get a lot of investors from that channel as well.
So the digital channel would be like if someone is searching for, like, say, invest money, then he'll see a Google ad, something like that. Or like best rate of FD, for example, someone searches, then you know that if he's looking for an FD good rate, then he would be interested in your products. Those would be like the approaches there.
Yeah, we have our own, display ads as well. And obviously, yeah, there are certain keywords that if people, they do search about that, then Giraffe as a platform comes up.
So in the digital space, there are two, three things that work, Akshay. So one is, the people who invest and who have, already participated on the platform or registered, there is a certain persona of these people that you can identify. So then you can also, kind of through Facebook, Instagram, today Google, Facebook, they provide a lot of, I would say, advanced algorithms to actually then target people of these personas out there in the world, right? So we know that these have been early adopters. How many of, like similar kind of people can we target through our, like Vineet mentioned, display ads, Facebook advertisement, Instagram? So this is, a digital acquisition route where, see, we focus on some keywords and, what people are looking at, but really also targeting some user personas that have done well for us and people who have transacted, right? So, and this is something that you can scale. And yeah, the third thing is you can also have a lot of these, I would say, non-digital ways of acquiring customers as well, which we need those initiatives, like for example, investment clubs, HNI groups, a lot of these associations, and we again, actively work with them. A lot of corporate webinars, right? Like these are again things that you can do through non-digital channels to acquire customers.
Okay, okay. So the financial advisor channel would earn something in it, right? Like you must be giving them some amount of the sum of your margin you must be sharing with the financial advisors who get in.
Yeah, so we are sharing a part of our fee that we earn. So we earn, certain fee on every transaction that we do. And we are happy to share, 50% of what we earn with the financial advisor, right? So which is like a distribution fee that we pay them for, taking our products to that.
What's your roadmap now? Like, what is the North Star metrics which you track? What do you want to hit as numbers? What all categories do you want to get into? And like, just help me understand like the road ahead.
Yeah. So the North Star metric that we track is, number of customers and AUM per customer. And, for us, customer is both companies as well as investors. And so effectively, month on month, we want to increase the number of customers that we have, either, both on the supply side as well as the demand side, right? More number of companies that we work with, more number of investors on the platform. And we need to keep servicing the relationships that we have built in the past to ensure that we are growing our exposure with them, or they are growing their exposure with Giraffe as a platform. So that's the most I would say critical metric for us. For example, if we acquire, just using this as an example, if we acquire 100 customers and on a new customers in a month, and those 100 new customers invest 1 lakh, that means that I have brought 1 crore of additional money on the platform. And this 1 lakh customer is likely to invest up to 10 lakhs in the next 6 months, 1 year, 2 years, 3 years. So by acquiring these 100 customers, I build a potential to, increase my performance scale to the tune of 10 crores, right?
Does data back this, like 1:10 ratio, that whatever is their first time investment, they end up investing 10x of that over lifetime?
So we typically see, someone investing almost, I would say 8, 9x by month 3, month 4 itself, right? So that's the data that we've seen. So, typically like if you are a new customer, you invest in month 1, like the data that we've seen is 50% of the new investors invest a second time in the same month itself. And they, on an average, people transact 3 to 4 times in the first 3, 4 months. So basically they're transacting 3, 4 times just because of without getting any capital back, because we don't have any product which is lesser than 3 months. So without getting any capital back, They are reinvesting just because of the confidence. Obviously the ease of transacting on the platform, our tech is very, very seamless. They are reinvesting again because our customer service and success team, I think they do a fantastic job of, onboarding new clients onto the platform. And they're also reinvesting because of the transparency and communication that we have with them, right? So without actually having capital coming back to them, they are building that confidence in a few months itself to build a decent enough exposure with us.
And how do you source deals, like companies seeking money? You have like a team which is going out, and like, what is the strategy? That must be relationship based, right?
Yeah, we have a proper investment team, and the job of this team is to source transaction for us. They do maintain relationship with various companies, so at any point of time, they will be say in touch with 40, 50 companies on a constant basis. So they keep on evaluating the transaction. They do the hard job of structuring the transaction, doing the due diligence, getting the transaction approved internally from a risk and credit committee. So we have a proper team in place to do that job.
What is like, what could be a black swan event for Giraffe? I just want to understand what could be the worst case scenario.
I think the thing which are most, I would say, cognizant about and that we face is obviously any risk of default of the product that we do, right? So from day zero, we knew that when you're trying to build a retail investment platform, managing risk is the most critical aspect of scaling a platform like us. When we set out Giraffe itself, we mitigating this risk and was the cornerstone of it, right? Like, how do I protect the impact of any, like you said, like a black swan event, like a credit default? How do I protect retail investors from it, right? And there are some three things that we do fundamentally to ensure that, right? We do only short-term products. So average majority of our products in Giraffe are 1 year or less, right? And why do we do short-term? Because underwriting debt or evaluating debt for short-term is easier, because I'm not taking a 5-7 year view of the company that I work with, right? I clearly know how they are today, and I'm taking approximately a 1 year view of where they will be, right? It's far more certain in that sense. Second, all our products, we have periodic payouts. So that means even if you invest for 1 year or 15 months or 2 years, you will get some money on a monthly or quarterly basis. What that means is that your exposure to every investment on the platform keeps reducing with time, right? Third is we have a very well diversified book. Today we don't have more than 3% exposure with any of the company that we work with, right? So that means we have a very, very diversified book at our end. That is something we constantly keep tracking and managing. And fourth is we expect the investor to be diversified at his or her end, right? So, if you are investing 5-6 lakhs on the platform, the idea is to do it across 3 to 5 opportunities, right? Or if you're investing 10 lakhs, you do it across 5 to 6 opportunities, right? And what we hope is that if now there's an investor who keeps participating with Giraffe over a 10-year period, right? The risk of corporate default in a very, I would say, if done rightly and managed well, is less than 1%, right? So if you're investing consistently again and again and churning your portfolio, you're diversified at your end, Giraffe is diversified at our end. Your exposure to a investment keeps reducing with time, and effectively we are doing short-term debt where the chances or the probability of default is lesser than the regular corporate default numbers or rates. We believe that when an event happens, the impact to an individual investor at a portfolio level will be minimal, right? And then they will appreciate the consistency that debt can give you over a long period of time. We started with a 1 lakh threshold because we were targeting a bit more financially savvy customer base, because we knew that the product in current shape and form is not ready for mass retail participation. We don't want to open it up for participation to an investor who's investing 10,000, who doesn't understand financial products, who's not had a long enough investment journey of his or her own money, right? Because everyone who's had that journey has gone through cycles, understand risk reward and how that plays out. Right? So the idea was that we kept the threshold high. We said we will, start with a more savvy base where we can explain and educate them in a easier way to start investing in these. And as we keep innovating on products, keep building products which are inherently less risky, structurally less risky for retail participation, reduce the threshold for participation, right? And the idea is, obviously, our vision is to democratize this space and help as many individuals out there to participate in fixed income.
What do you want to bring it down to, your threshold from 1 lakh?
Ideally, if you ask us, like 20 years later, it should be 1,000 rupees, right? That's where we want.
Wow. Okay. And probably on the roadmap for the product, you would also want to create then some sort of an SIP so that every month, whatever you save can go into the platform, some sort of a automatic reinvestment.
All of these things are in our mind. We are trying to, like, that's a, unfortunately, mind to execution takes a long way, right? We think that we want to deliver everything tomorrow, but unfortunately, it's a journey of many years.
So you've raised 7.5 million so far. Do you need to raise more funds?
So, again, we are one of those businesses which are fundamentally not very OPEX, ops heavy, right? Like, so we are a very high margin business. We are, basically are beyond our fixed costs, which is people, a bit of digital marketing. There's not really much, that we spend on, right? So we are a very low cost business in that sense. Our idea is to break even in the next 12 to 18 months. In a business like ours, money is always a raw material. So while we are profitable, obviously capital gives us significant strength to grow, and that's
You need capital, you need that balance sheet strength, because you are on the basis of that strength is how you are giving assurance to the borrowers. So if you want to, for example, start dispersing 1,000 crores a month, then you would need a balance sheet which has at least 200 crores in it or some such ratio.
no, few things. So, for example, we want to participate in risk with along with our customers, right? So today we don't do that, but one of the things we say that what is the difference between traditional wealth firm, like again, let's say Edelweiss Wealth bringing an opportunity to you and Giraffe. Right now, the difference is that Edelweiss Wealth is distributing a third-party product. They have no skin in the game. They are, they are not manufacturing the product themselves. They are just a pure play distributor. But we as Giraffe, we are saying that, hey, this is a product that we believe in. We believe in the credit quality. This is something that we have manufactured, curated, especially for you. And and hence we want to also put our money where our mouth is. So we say that we will participate to some extent in the risk alongside you with our own capital. So if we have some balance sheet strength, then we can aggressively commit capital and push external, I would say, demand. Right. So that's all.
Very cool. And how high touch is the business? Like, as you said, Edelweiss is very high touch. In your case, do you have calls and so on happening, or is it entirely online, the workflow of investing? Like you go online, you choose a product online, you pay online, everything online.
It's majorly online, but a first-time investor, obviously, when you are investing for the first time, they do tend to talk to our customer care or an RM. But what we have seen is that, once they have done a couple of investment, then it's very low touch. Then they know where to look at, what to look at, how to invest. I would say 99% of their queries have been answered, unless it's something very specific challenge that they are facing.
And do investors have the option to, in an emergency, withdraw what they invested?
Not right now, but we are trying.
One of the problems we are solving.